Hi, it's Jim Parker. Please do me a favor. Right below, you're going to see a subscribe button. Click that subscribe button so you can subscribe to this YouTube channel. I'd greatly appreciate it. Just take the time right now, put the video on pause, hit that subscribe button. All right, enjoy the upcoming program. All right, welcome fellow business brokers. Thank you for joining me today. I'm really excited because today we're going to be talking about how sellers and buyers can save on taxes. You know, this is the thing. Most business owners, when they're looking to sell the business, their biggest concern is how much money am I going to get for the sale of my business? And really, they should be looking at not how much they're going to get for the sale, but how much they're going to be able to keep afterwards, and they're going to be able to put it in their pocket. And that's what we're going to be discussing today. And I'm really excited because today we have Dr. Bart Basi with us. He is one of the country's renowned experts on tax planning. And I'm really excited to have him with us here today. Bart has taught for the IRS, right? For years, you've taught for the IRS. And you used to write their tests for them, right? That CPAs had to take?
We do once a year. We write we're one of the few firms that do. That's correct. As a matter of fact, I just found out today, they're still asking Congress to make it mandatory for all tax return preparers. Over 60,000 people take the classes, but there's a lot more that file tax returns, and there's major problems with them.
Yeah, great. So, I mean, you got the guy that's writing the test for the IRS. You got the guy that's teaching CPAs about it. He's an attorney. He's a CPA. He has a degree in economics, a degree in accounting, and a degree in law. Is that correct? Am I missing anything?
Yeah. No. Okay. I still take out the garbage on Monday night.
And okay. Listen, I don't want to go on and on because, you know, Bart here has, tons and tons of accomplishments, but I want to get right to the point. Bart, why should a buyer consider a C-Corp instead of an LLC or an S-Corp?
You know, this goes back to when they passed the tax law at the December of 2017 that went into effect January 1st of 2018. What they did was they lowered the tax rate for C corporations to 21% flat rate. So if any person in business thinks they're going to be making more than $50,000 a year, that's the net profit break point. A C corporation makes sense because instead of paying taxes as a sub S, and taxes as a sub S are taxed to the owner of the sub S at their personal tax rate, which obviously can be up to 35%. So would you rather pay taxes at 21% or 35%? It's a simple calculation. There's a second reason it's very, very important. It's been with us for several years, and it's more important now in 2020 than you can imagine. There's a special tax law that says if you form a corporation, the law, a C corporation, you're buying a business and you're forming a C corporation to run the business, the law says that the tax law says the tax code that's in effect in 2020 will control the sale of your business in the future. And the law says that you've got to own that C corporation, form it in 2020, and operate it for a minimum of 5 years. Then you can sell it. So all brokers that are selling companies know the buyers, and they should stay with the buyers because in 5, 6, 7 years, that buyer can sell that company. Now watch this carefully. This law is phenomenal. And I teach CPAs and attorneys and they're stunned. There's a law that says if you form a corporation in 2020 and run it for at least 5 years, and when you sell it, you're filing a personal income tax return, obviously, okay? If you're married, filing a joint return, the first, and I'll say this very slowly because it's important, the first $10 million of profit are tax-free in the United States. Can you imagine?
Way. No way. Are you serious?
I'm serious. If you're single and you're filing a separate return, single return, you're not filing a joint return, the first $5 million of profits, not sale price, of profits in the United States are tax-free. Now, it's amazing, Jim. Let me give you a quick illustration. This law has been with us for a while. As a matter of fact, we're just working with an insurance company that formed a C corporation several years ago. It's $16 million, by the way. The C corporation, the insurance company is being sold. We went back to the year in which that person created the corporation. The law back then said 50% of the profits were tax-free. So when we sell the corporation, and we're not brokers, we're working with a broker who helps the deal. But the seller is so enthralled with what we can do because he's going to sell a business for $16 million that he started with $100. So let's assume he makes a $16 million profit. Can you imagine that $8 million will not be taxed at all in the United States because the law at the time he started it said 50% of profits were tax-free. And the law also said at that time, okay, that any profits that are taxed cannot be taxed at more than 28%. So even though this guy is going to get $16 million and it's going to show up, on his personal tax return as a sale of his business, he will only pay an effective rate of 14%.
Wow.
Zero taxes on 8 million and 28% on 8 million, effectively paying 14% taxes.
That's really, Bart, that's really interesting. But you're saying right now, so in 2020, if somebody's setting up a new corporation, buying a business, you're saying that they should set up as a C-Corp.
Absolutely.
Because
unless
right
they
now,
don't plan to make at least $50,000 in profits. That's the break point.
Okay.
If they plan to make $50,000 or more in profit, they should form a C-Corp. And don't ever have the brokers and the clients worry about what they call double taxation.
That was going to be my next question. So tell me about that. Like, why wouldn't that affect them in double taxation right now?
It doesn't affect private companies. You're correct.
It doesn't. Okay.
No, it affects. Look, General Motors makes a profit. They pay taxes. You're a stockholder. You're an investor. You have nothing to do with the company. You get a dividend. You pay taxes. That's called double taxation. Tell me what private corporation ever gives dividends.
Right.
If you own a corporation or I owned a corporation and we wanted money, we take it out as an expense. We take it out as a bonus, or we increase our salary. Either way, the company gets a tax deduction.
That's so fascinating. Holy cow. That is great, Bart. I mean, right there, we could just end right there and we picked up a big piece of information.
Yeah, it's amazing. Matter of fact, recently I was contacted by an attorney in the state of Colorado who said, we need your expertise in a court case. And they were suing someone who works with brokers and provides advice. And evidently the advice the individual gave the seller was not correct. I turned the job down, Jim. I do not want to get involved in suing brokers and suing their people who work with them, especially when they're related and they speak at the IBBA. It's just not important to me. So I was, quote, too busy to help. But people have got to realize that taxes, as you mentioned at the beginning, taxes are so extremely critical. It's not what you sell a business for. It's what you can get the client to keep after taxes. And what I'm telling you, and as your question was, help the buyer as well. Brokers should stay with the buyers, keep the relationships up, because if they do it right, in 5, 6, 7 years, that buyer's going to resell that company.
That's crazy. That's great. That is great. And you said that you talked to a lot of accountants about this, and accountants were not familiar with this either, right?
Not at all. Listen, there's an accountant out in California who gets a software program. He says, Bart, he says, I file 200 tax returns a year. I don't know anything about taxes. I just buy the software program. I plug in the figures. I file their returns. I don't give them any advice. I don't want to get. Okay.
That's not right. That's not right. So tell us about
what happens.
Tell us about tax returns and the seller's tax returns and how that plays into taxes. When you look at the tax returns, I think you were talking about balance sheets, page 4. You and I were talking about that the other day, page 4 in the 1120S and the balance sheet and how that plays and everything.
Yeah, I've just got a client who just sent me about 5 or 6 tax returns. As a matter of fact, he's in Kentucky. Don't mind mentioning the states. I can't tell you anything else, and I'm going to conference call with him and his father on Monday. Every tax return, whether it's a subchapter S or whether it's a C corporation, and partnerships should also include them, although a lot of them on small businesses don't include them. They have a balance sheet. And actually, there's 2 balance sheets. There's a balance sheet at the beginning of the year and a balance sheet at the end of the year. Following the balance sheet, which is typically on page 4 or page 5, depending upon the form, there's what is called an M1 schedule. And then right below that, there's a schedule called M2. These are some of the first things I look at. I look at the balance sheet and see what they've done between the beginning of the year and the end of the year. And then I look down, for example, at the retained earnings. The retained earnings at the beginning of the year and the end of the year change. And so when I look at that change, I want to see why it changed. So M2 schedule is supposed to be why it's changed. Now, I get many CPAs. Matter of fact, I got an email from a CPA now saying, well, Mr. Basi, I don't know what to do because they took a loss and therefore the M2 schedule will show a negative figure. Makes no difference, Jim. If the retained earnings on the balance sheet is negative, then the M2 schedule is supposed to be negative. So the M2 schedule is supposed to be a reconciliation between the beginning retained earnings on the balance sheet and the ending retained earnings on the balance sheet. Now, I skipped the M1 schedule. You might say, Bart, a lot of accountants who keep records for businesses, for sellers, keep basically two sets of records. They use one method of accounting for their accounting records and a second method of accounting for their tax records. So the M1 schedule says, look, what's the difference? Reconcile the profit that you've reported on page 1 of the tax return with the profit you've shown on your accounting system. Now, if they're using the same method, it'll simply be beginning and ending is the same. There'll be no difference. But many accountants, as a matter of fact, I came across one CPA now, and I felt so bad for him because his first words were to the client, he says, please don't sue me. Because he showed a balance sheet on a tax return that was under generally accepted accounting principles. It's an accounting method. Mm-hmm. It doesn't apply except for publicly held companies. This is a private company. But the accountant kept the books, the accounting records, based upon a publicly held company. So the balance sheet profit, the profit on the P&L statement, I should say, that refers to the balance sheet, did not agree with the profit that was shown on the tax return. Well, the M1 schedule is supposed to reconcile it and explain that. He didn't fill it out. He left it blank. You can't do that. So advice to brokers. When you're dealing with a seller, when you're getting their financial statements and their tax returns, take a look at page 4 or 5 when you see the beginning balance sheet and the ending balance sheet. Look at M1 and M2 schedule. Make sure that they're there and they're correct. The M1 schedule simply says the profit in the tax return, what's the difference in the profit in the accounting records? A lot of times there's a difference. Okay. M2 schedule says, what's the difference between the retained earnings at the beginning of the year and the retained earnings at the end of the year? It should match. If it doesn't, it runs up a red flag. And this is something, especially when you get into valuations of businesses. What methods do you use to value a business? Do you come off the tax return? You come off the accounting records, especially if, like this one guy in Maine, the CPA in Maine, was using generally accepted accounting records for accounting, but using a different method for taxes. Look, I've got a client right now. We just approved his 2019 tax return. Very good person. Okay? On the tax return, he's going to show a $34,000 loss. And by the way, I'm smiling because that's with $22 million of revenue. Okay?
Wow.
But he's made over $1.5 million in cash. Now, you might say, Bart, how can this happen? Because he has a lot of locations and a lot of equipment. And the tax law says you can deduct all the equipment in the year in which you buy it, regardless of how you pay for it. So if he purchased $2 million worth of equipment last year for his locations, we could deduct $2 million against his profit, and it ended up where, for tax purposes, we're going to show $34,000 loss on a $22 million company, but he's actually made $1.5 million in cash.
Wow, great.
So it's important for brokers to understand revenue versus what's reported profit. Don't go off of the tax return profit. Okay, 9 out of 10 times it's wrong. As a matter of fact, a lot of brokers, Jim, try to, and they take classes and so forth, and I get nervous sometimes, people who teach the classes, because they don't really understand it. When you reconstruct a financial statement, you can't reconstruct just a P&L statement. You also have to reconstruct the balance sheet. And people don't realize that. And it's major problems when we go in as to what a business is worth. I had a broker call me and he said, Bart, this guy won't sell because they told him his value was, $3 million when he got offered $1 million. Can you take a look at it? But when I looked at the way the valuation was done, they didn't consider some items, and the guy his company wasn't worth $3 million. They had made a mistake and used a method that is not acceptable today. And what it is you've heard of comparables, Jim? Yep. Okay. You can't value a company with comparables. You value a company based upon its operations and its assets, its earnings, its goodwill, its cash flow, and then you compare it with comparables. But you can't say, look, I've got a private company, and the only comparables that the accountant can find are publicly held companies.
Yeah.
You know what happens to the value, Jim?
Yeah, that's crazy. Yeah. You can't compare a business doing $2 million in revenue to a business doing $75 million in revenue.
Thank you. So the accountant or whoever he hired to value the business used the comparables method and said, geez, based upon all these publicly held companies, you're worth $3 million. Where in fact, when we ran the assets and the cash flow and the profits legitimately with add backs, he was worth about $1.2 million.
Right, right. Well, I think most of us on the call right now, we use comparables, but we're using privately held comparables in the same gross sales range.
Yeah, you got to be very, very careful. You cannot use publicly held comparables.
And you were saying that, you recommend business brokers that they, look at page 4, page 5, look at the balance sheets and make sure it makes sense. I'm going to go one step further. And I see that a lot of times business brokers will only ask for the front page 1120S form of the tax return and the other deductions page. And they only ask for those 2 pages, and really just get the whole tax return and really look through the whole tax return, because there's a lot of information in that tax return that you need to be aware of. But I want to move on. Bart, I think it was back in 2017 was the change in law when it comes to the 1031 exchange. And I think some business brokers are still misunderstanding that change or are unaware of that change. Can you describe that?
Okay, a 1031 exchange is where, let me just give you the general definition first. The 1031 exchange is where you take one piece of property and you exchange it for a similar property that's used in business. So a truck, a company uses a truck, they trade a truck in and they buy a new truck. That has always been considered a like-kind exchange. And on like-kind exchanges, it's always been tax-free. Now, the basis of the new property is the basis of the old property plus any cash paid. So let me just make it simple, okay? I'm an old professor, so I don't want to get it too complicated, okay? Let's assume you've got a truck that's $50,000 and it's worth $10,000 on the books. It's traded in, okay? Well, if it's on the books for $10,000 and you buy a truck for $50,000 and you've traded in the $10,000 truck, well, your new truck actually only cost you $40,000 because you've got to pick the cash that you paid and the basis that's on the books of $10,000. Now, here's what's happened in 2017, starting in January 2018. Hate to say this, but the law only applies to real estate. It no longer applies to businesses. It no longer applies to cars, to trucks, to computer equipment, to desks. It applies nothing except real estate, okay? Years ago, I could sell a business, and I said, I always ask the person, what are you gonna do with the money? Well, I'm gonna buy another business. Well, if we could buy another business and sell one business, we could have a like-kind exchange and not pay taxes on the sale. Mm-hmm. I had a guy in Pittsburgh, Pennsylvania years ago who sold a farm, and he retired to Florida and bought a condominium. As a matter of fact, he bought several condominiums, okay, with the money he got from selling the farm. And so we considered a like-kind exchange because one was producing income, another was producing income. Unfortunately, today, everything is subject to tax unless it's an exchange of real estate.
Okay, good. I'm glad we got that cleared up. And go one step further. You can't have an investment property, sell that, and then buy yourself a vacation home, correct? I mean, it has to be an investment property for an investment property. Yeah. Now, Bart,
rental property.
Bart, and I think we move on from the 1031 exchange because I think it's very straightforward. We just can't do it as business brokers right now unless they change the laws. You were saying that you wanted to talk a little bit about a article that was in the Wall Street Journal that appeared in the Wall Street Journal on Monday.
Oh, boy, I got to think a second.
It had to do with a law change in December of 2019.
Oh, yes. Oh, I'm sorry. There's so much going on in tax law. On December 18th of 2019, Congress, in its ultimate wisdom, decided to go back to the 2017 tax law and bring back 33 different laws that they eliminated as of January 1st of 2018. 33 laws, Jim, which meant everyone who had filed their 2018 tax return could go back and file an amended return. Let me just give you 2 key items.
That must have been a nightmare.
Oh, I loved it, by the way. You got to realize it's all job security, okay? I mean, people started calling me, Bart, what's going on? And yes, we filed a lot of amended returns. We helped accountants file amended returns. Let me give you a quick illustration. Prior to January 1st of 2018, I got to make sure you understand exactly how it was changed. Prior to January 31st of 2018, if someone had a profit in one year, they paid taxes, the company. And then the following year, let's say they had a loss, they could go back and file an amended return for the prior year and ask for a refund. Simple. You could carry back a loss to a prior year and file for a refund. As of January 1st of 2018, Congress said, we're no longer going to allow carrybacks. You can only carry it forward. So if you had
wait, Bart. So I know where this is going. This is going this year where businesses might be taking a loss.
God, let me tell you what happened and why the Wall Street Journal article is
Wow.
so timely and critical. I write articles myself and I send them to the Wall Street Journal. Unfortunately, they don't publish as a matter of fact, one of my sons is named in the Wall Street Journal a lot of times because he works for the University of Missouri and they quote him a lot. So what I'm saying is that in 2018, if you had a loss, you could not go back to 2017 or 16 or 15 and file an amended return.
Right.
You're going to carry that loss forward. Well, guess what happened December 18th of 2019? Congress said, we're going to allow people to go back for 5 years and deduct losses up until December 31st of 2020. Wow.
That's huge this year.
Oh my God, yes. And this is why, not only is it huge, but watch, Jim, the benefit. Now watch me carefully. My sleeves are rolled up, nothing under my sleeves. Let's assume in 2020, you've got a client who has a loss. Under the law that was in effect, they could not go backwards. They could only carry it forward. Now, if they're a C corporation, and this is what the article, by the way, was for C corporations, they could go forward. And if they made a profit in 2021, they could take the loss in 2020, offset the profit in 2021, and they would save how much in taxes, Jim? 21%.
Mm-hmm.
Got it?
Mm-hmm.
But if they now have a loss in 2020 and they had a profit in 2017 that they paid 35% for, they can go back and get a refund of 35% of those taxes instead of taking it for 21%. So the article in the Wall Street Journal said, my God, first of all, many, many companies became C corporations because of this new law. So now everyone, if they've had losses in 2018, 2019, and or 2020, go back and file amended returns. Don't carry it forward, carry it backward and get a refund of up to 35% in taxes, and you don't have to carry it forward.
That's incredible, Bart. That's incredible. When they did that in December of last year, they probably, the economy was humming. They probably never expected it to take a downturn like it did.
Signed the law, by the way. I think it was December 20th he signed into law. So, it was not just Democrats or Republicans. It was even the president that approved it. 33 different laws. You'd be surprised what other laws have been put in. It's amazing.
That's great.
And accountants don't know this because they simply buy computer packages. And by the way, and I won't identify the company publicly, but there was one company that sells computer packages for filing tax returns to accountants in the United States, and they did not keep up with the law. So all the tax returns filed by this company or by using this software program, the IRS came out and said everyone can file amended returns and there'll be no penalties at all because the software was wrong.
Wow.
That's a true story. And the IRS brought a lawsuit against the company because they failed. They were publicly selling their software program. I can't identify the company. It's very big. And they were aware that they had not updated their programs.
Can you do this for us, Bart, moving on, talking about the stock sales and the asset sales? How does a stock sale affect taxes versus an asset sale?
Okay, that depends on the investment and the basis of the assets being sold. Typically, and of course, it also depends on the structure of the company. If it's an LLC, how is it being taxed? If it's a Schedule C and they're not incorporated, if it's a subchapter S versus a C, so that it applies to differently. But in general, people are afraid to buy stocks in companies because of the potential liability that can. So what happens is, first of all, I don't sell insurance, so understand that. But the seller can buy insurance policies to cover for any discrepancies or any losses or any claims that come up as a result of a buyer buying stock, so that the buyer is indemnified. Okay, so that's a possibility. Second, when you sell stock, we have to make sure the corporate record book is up to date and correct, and then we give warranties. And by the way, one thing that I teach attorneys, as a matter of fact, I just had a problem with an attorney. If your clients buy stock, they have to be classified as a sophisticated buyer in the United States because you're selling privately held companies. There's a definition of a sophisticated buyer.
They have to have $1 million worth of assets outside of their home. Is that
you got to say, I can afford to lose this investment. And if that is not contained in the legal contract, the seller can be held liable. And the Supreme Court has held the sellers liable, not just for what they sold the business for, but for all the expenses of the buyer, because the buyer wasn't a sophisticated buyer and didn't know that at the time they bought. Very, very critical. I just corrected a contract made by an attorney that shouldn't have written the darn thing. He's a litigator, had no business writing a business contract selling stock and did not have the sophisticated investor clause in there. All right, that's one item. Second item is that.
Wait. Can I pause you right there real quick, Bart? So, because we're, us sitting here on the call right now, I mean, we advertise our businesses as asset sales, and once in a while, the seller and the buyer get together and they go, hey, this has got to be a stock sale because, the contracts that are involved and that type of thing.
Yeah, very much so.
Is there a way to do it where the buyer does not have to be a sophisticated buyer and he signs a disclaimer and we still move forward, or?
Yes, he has to sign a disclaimer saying he can afford this. He has the wherewithal. It will not affect his standard of living. Good terminology. Okay. That's got to be.
Even if he's getting a loan, like an SBA loan or something like that, can we make that deal happen?
Yes.
Okay.
Now, SBA, I work with I don't work with the SBA. I work with banks who are SBA approved lenders.
Right.
Okay? And they're normally very cooperative in working with you as long as the documents are drafted properly. Okay. I've got a big transaction right now going with a bank. I won't identify it because it's a well-known bank, but I can't tell you how cooperative they've been to me. Dr. Basi, whatever you need, tell us. As a matter of fact, I just sent him an email this morning and said, hey, you've got a worksheet. Can you send me the worksheet you use internally so when we draft this, we can draft it in accordance with your worksheet? Mm-hmm. By 5 o'clock tonight, I'll have that worksheet in my inbox. Okay.
Wow.
So that's important. Also, in selling stock, if the asset base, if the structure is correct, you might end up paying less taxes than if it's an asset sale. Because an asset sale, a lot of these sellers have deducted everything in the kitchen sink. So they have no basis. So everything is taxable. It is possible that a stock sale can actually generate more revenue. And as you mentioned earlier, we're running into a lot of situations where sellers have contracts. And the contracts go only with the business. So if the business is not sold as a stock sale, the contract's got to be renegotiated.
Which usually you don't want to have happen. So sometimes Bart, you got a situation where, you got those contracts that are involved. Okay. And the seller usually benefits, I'm not a financial advisor, but the seller's the one that usually benefits from being taxed as a stock sale. And it's bad for the buyer for a stock sale, but the buyer needs to buy that business as a stock sale because there's contracts in place. But a buyer can buy it as a stock sale and they can treat it as an asset sale for tax purposes, right? Because I think a lot of business brokers don't know that.
Yep,
I'm sorry?
There's a special election that's up to the buyer to make, and here's the key.
The seller has to agree to it, right?
The seller's got to agree to it because what happens is the seller's tax returns have to be changed as if he sold assets. And this can cause a tremendous additional tax to the seller. What we do is when we're negotiating on behalf of a buyer and the seller and a buyer, what we do is we ask the buyer, are you considering an election to convert this over once you get the licenses and everything transferred? And if they say yes, we put a clause in the contract that they agree to reimburse the seller for whatever additional taxes the seller has to pay because of the conversion. Okay. We sold.
And that's legal, huh? Wow.
Oh yeah, we sold 4 companies by an individual as a stock sale because of the contracts. These were government contracts, by the way. So the buyer had to buy the business. Well, the buyer had contacted me just before we closed and said, Bart, we might want to convert this over to a 338H10 election. I said, well, we put a clause in the contract. So we calculated what the extra taxes would be. Let's make it simple. Let's say the extra taxes would be $100,000. Okay, so we wrote in the contract. The seller will agree to a 338H10 election as long as the buyer gives them an additional $100,000 to pay their taxes. The buyer has refused to pay the $100,000. The seller has refused to sign off on it. The buyer only has so many months in which to make that election. They can't make the election without the seller's permission.
Wow.
I won't tell you the type of company because some of the listeners may be involved in that industry, but it's creating a problem. And the seller said, Bart, we wrote in the contract. I says, I know. I says, like Jim, I would say, I know, Jim, we put in the contract, we covered you. You have to pay approximately $100,000 in taxes. They should pay you the money. If they refuse to pay it, I can't tell you to sign or not sign because the contract says you would agree only if you received the $100,000 additional for tax. Because the seller has to convert his transaction to an asset transaction and pay the extra taxes. And the buyer gets a stepped up basis.
Great. Hey,
Very
Bart.
sensitive issue, Jim.
So the what's going on with the non-negotiable note right now? Like
I love
enlighten us about the non-negotiable note.
that. Listen, I have a broker out in the Arizona, Nevada area who loves me. Not that my wife doesn't, don't get me wrong, okay?
We all love you. What are you
All right?
talking about?
But he said, Bart, you saved the deal. Let me explain. If there's a note involved in the transaction, 99.9% of notes are negotiable. The word negotiable means they're the same as cash. That means they're taxable, Jim.
Meaning,
Even if
wait. So, meaning you can sell that note. Like I'm carrying a note. I'm carrying a note for you, and then I can turn around and I can sell a negotiable note to somebody else.
You can use it as collateral and borrow. That means it's negotiable.
Mm-hmm.
Tax law says if you receive a regular note, it's negotiable, it's taxable. Let me give you the worst case scenario that I had. Silicon Valley, gentleman sells his business. He has debts on his books. Okay, let me make it simple. I'll simplify it. Let's say he sells it for $5 million and he has $3 million of debt on his books. So he ends up getting $2 million in cash.
Mm-hmm.
But guess what? The note of $3 million that he paid off his debts with is also taxable. So he has taxes on $5 million, not on $2 million cash he received. That man paid over $2.4 million in taxes. He had to borrow money to pay the taxes on the transaction, did not make any money.
So if just the fact that they would have written on the note that it's a non-negotiable note,
it would not be taxable.
Just putting that language in there would have made it so that $3 million was not taxed.
What we do in the top of the note, we say non-negotiable note, and then we add a paragraph in the note and says, this note is non-negotiable, cannot be used for collateral or any borrowing purposes, has no value until it's paid.
Wow.
It's like an installment sale.
Wow. Very, very interesting. Now, is there times that you would want to have a negotiable note? Maybe like the capital gains taxes are really low in the current year, and you want to prepay the full taxes up front. Yeah. So, okay, so go ahead.
If there's a concern, the tax rates are going to go up. For example, a lot of people now are calling me and saying, Bart, what's going to happen in the election? I don't know. But if the parties change, then there's a concern the tax rates are going to go up. Well, if tax rates are going to go up and you've got a note, you're selling your business and the note's going to be paid in the next 2-3 years, well, you might want it negotiable and pay taxes at this rate in 2020, as opposed to a rate maybe in 2024, 2025, when the tax rates could be higher.
You're paying all of the taxes up front in the year 2020, and then you're not paying any of the taxes for the next 4 years if it's a 5-year note, right?
Correct. And I hate to say this, but you don't know how many people file tax returns. I won't say just accountants or CPAs, just people who file tax returns, don't know this and create tremendous problems for their clients. I have one CPA right now who's filed a tax return and did not include a negotiable note. There is a problem. Okay. Because underpaid the taxes. So
this is why I think as business brokers, and you can elaborate on this, their sellers and buyers should not be going to a typical, attorney or CPA to be getting financial advice when it comes to selling or acquiring a business, because there's huge tax implications. And if that person does not know this, I mean, because I know from talking to you, you've saved sellers and buyers hundreds of thousands of dollars.
We try.
So that they need to be going to somebody.
If you're going to get a divorce, you're not going to go to an attorney who specializes in tax laws, are you?
Right. No.
Okay. So if you're selling a business, why would you go to a divorce attorney? If you're buying a business, why would you go to a litigator? Okay. Look, I'm working right now with an international law firm. Now, you're in the state of Florida, correct, Jim?
Yep.
I'm in the state of Florida right now, okay? I'm working with an international law firm that has an office in the state of Florida. Very, very large law firm. Now, this law firm is located in the state of Florida, and there's Florida law. You would think that the attorneys would know the Florida law. So I talked to the attorney, says, Mr. Basi, I'm sorry, I'm a litigator, but we're helping a client buy a business. I says, well, but you're buying 85% of a business and the seller's going to keep 15%. You know this, some sellers keep skin in the game. Well, there's a law in the state of Florida. When you value a business in the state of Florida and you sell that business, you cannot treat a minority stockholder any different than you treat a majority stockholder. Now, that law was only for stockholders there were 10 or fewer stockholders, but in July of 2020, the Florida law changed. Now, these people are attorneys in Florida and they don't know it. Why? Because they're litigators. So I had to actually copy the law out, email it to the attorneys so they would understand what the law in the state of Florida says with regard to treating a minority stockholder the same. In other words, you can't say you own 15% stock, so your stock's worth $100. I own 85% stock, my stock's worth $3,000 because yours is going to be discounted because it's a minority. That's not allowed for private companies in the state of Florida and some other states too. So
I think,
insurance, I'm sorry. So point I'm trying to make is not about the Florida law, but about attorneys and accountants. Okay, if you go to someone who just files tax returns and uses a computer program, like the guy I mentioned in California, you don't go to them for advice on structuring a deal. Attorneys, check their backgrounds out, see what they specialize in. Okay, and if they're litigators, if they're divorce attorneys, if they're trial attorneys, if they advertise for clients for personal injury.
Right.
Get you out of a speeding ticket.
You know, that's the thing we face as business brokers because we're on the front lines, Bart. You know, we're working with a seller, for instance, that's owned a business for 25 years and he's been using the same CPA and the same attorney for 25 years. He really likes and trusts both of them. And you sit there and you tell them, okay, they're great people for what they do. And they might be fantastic at what they do, but you need an M&A attorney to be looking over the contracts, and you need a tax planner for acquisitions or, selling a business to give you advice on saving taxes, because there's huge implications. You can't use those people for the same thing. And it's hard to get them away from them sometimes. And that's what we've got to do as business brokers. We've got to do a better job as business brokers educating our buyers and sellers to use the right people. Because I think most CPAs, most attorneys, even though it's outside their scope, they still accept the work.
That's correct.
And we got to kind of say, hey.
In our firm, we do not want to take work away from local professionals. So what I tell clients is, look, I'll work with your local professional. Okay, I'll let the accountant file a tax. Let me review it before they send it in. If you've got a local attorney, let me review that legal contract ahead of time. Now, the interesting thing, Jim, you'd be surprised the law firms and the accounting firms that call me said, Bart, you had this other job. I wasn't really crazy about working with you, but I got another client. Can you help me with someone else? I would say probably 20% of my work comes from professionals that I work with, and I try to cooperate with them without taking work away from them. Okay?
I think that's great. That's great. As a matter of fact, I'd rather educate them than just say, hey, you did it wrong. You're wrong. Take it. Let's talk about, I'm going to open this up for a Q&A. If you guys want to raise your virtual hand, I'm going to choose the people to raise the virtual hand first and bring them in to ask Bart any questions you might have. But while you guys are raising your virtual hand, I want to ask you another question, Bart. In regards to the opportunity zones, and if you could talk to us about the opportunity zones and how you can save, sellers that sell their businesses, tax money.
Very simply. When you get a seller who wants to sell their business, ask them what they're going to do with their money. Because the government a couple of years ago, has designated every city in the United States has an area they would like to see upgraded. We call them an opportunity zone. As a matter of fact, I hate to say this, but some cities, the entire city is an opportunity zone, okay? Now what this means is, and it applies only to people who sell companies. So it helps you people. I had a client who owns a company. He says, Bart, can I invest in opportunity zone? I said, there's no benefits. But I said, if you sell your business, you can invest. Here's what the law says. If anyone who sells a business decides to invest in real estate in an opportunity zone, increase it, fix it up, okay? Spend 30% in a couple of years. They will not pay taxes on any of the transaction as long as they hold the property for 7 to 10 years. Let me give you an example of how I saved the person a tremendous amount of money. And I'm not just bragging, I'm just trying to give you a fact. I get a guy who calls me, he says, Bart, we sold 4 houses in this city this past year. We've made over $2 million. My accountant says I got to pay taxes. I says, what are you going to do with the money? He said, well, we're going to buy more houses and renovate more houses. This is what my father and I do. I says, well, wait a minute. There's one sheet of paper. Now, let's say he did this in 2019, that he sold these 4 properties. He's not going to buy more properties until 2020. He sold a business. Okay.
Right.
So we filled out one form, attached it to his 2019 tax return, one sheet of paper, Jim, one sheet of paper that says, I made all this profit from selling this business and selling this real estate. It doesn't have to be real estate, it could be any business. And I'm going to invest it in an opportunity zone in the same city, but I got to file this tax return before I invest it. He paid no income taxes at all on the sale of his business. And in 2020, he's investing now in the opportunity zone by buying some real estate. He'll, fix them up type thing, hold them for, let's say, 10 years maximum. And all the profits from the sale of a business is tax-free.
Wow.
This is not state law. So your brokers who are listening in should ask their clients, would you be interested in investing in property in your opportunity zone? It's on the internet. Any broker can go to the internet and check the opportunity zone in any city in the United States.
Is that tax-free or tax deferred?
No, tax-free if they hold it for 10 years. If they hold it for less than that, there's a proration.
Okay.
No, it's tax-free at the 10-year time period.
Wow, that's great. That's great. Hey,
this is an encouragement to businesses who are sellers of businesses, to invest in their communities.
That's great. Okay. Hey, Bart, we're going to bring people in because we're getting people that are raising their virtual hands right now, and I want to get them to build the answer. Ask you the questions they have. First, we're going to have Archie. Archie, with us?
Can you hear me?
Absolutely. And you're calling from Orlando, right? Orlando, Florida?
Well, Maitland, actually.
Maitland. Okay. What's your question for Bart?
My question is, what advice do you have for somebody that has a windfall profit, whether it's a broker commission or sale of a business or anything that gives him much more profit than he has had over the past 5 years on an average basis? What advice do you have for somebody who makes a windfall profit? For example, let's say somebody's making $100,000 a year for 10 years in a row. All of a sudden, in 1 year, he makes $600,000. What advice do you give somebody like that?
Okay. First of all, understand I'm not an investment broker, so I can't give investment advice. That would be illegal for me to do that. But having said that, if it were me, I would invest in real estate or I would invest in equipment. Even if I bought equipment and rented it to a company that wanted it. Look, I've got one individual in the state of the state of Illinois, who, very similar to your situation, Archie, is getting all of a sudden a lot of money. He's tied in with a used car dealer, and he now invests his money in financing used car dealers. And it's buying the equipment, buying the cars, and then he goes ahead and when the used car dealer sells them, he gets paid. Anyway, there's a tremendous tax deduction for depreciation because you can depreciate the whole thing 100% as for investment purposes. So I like real estate, I like that and equipment. You get a rental equipment rental company, and they're constantly looking for people to buy their equipment and then let them rent it. And they would provide an income, and then the entire cost of the equipment is tax deductible in 1 year.
Super. Good. Thank you very much.
Without giving you an investment advice, okay?
We'll call you, instead of Dr. Basi, now Count Basi.
No, God. I was a university professor. I've been called a lot of things. Okay.
Thank you. Thank you for your advice.
Welcome. Thank you so much, Archie. Leon, are you with us?
I sure am. Thanks for taking my question.
Where are you calling from, Leon?
Norfolk, Virginia.
So thank you for joining us.
Appreciate it. Appreciate the Florida Bubba's sponsoring this whole thing up, or however you make this happen, Jim. It's a great opportunity every week to learn something.
Thanks, Leon.
And Bart, thanks for being here. Last time I saw you was, had to be 15 or so years ago at an IBBA meeting before I got busy with doing other things. So, so good to listen to your advice and counsel again.
Thank you.
Two-part kind of a question. First question is, I'm back in the brokering game. I've got a client we're about to get an LOI on tomorrow. This business is going to sell for maybe $675,000, $700,000 up front and a note to follow for another few $100,000. Mm-hmm. And I know his advisors are good folks, but as you said, they're not transactional gurus. And so I hate to dig at costs to do this, but at what size of a deal does coming to somebody like you start to make financial sense for the sellers to come and get sorted out by you and make sure that we're not giving away money?
That's a great question,
That's a
Leon.
good
Great question.
It's one that I've handled many, many years. Leon, just quickly, I got into this business when I was teaching at Penn State, and my father passed away. It was a businessman, and he lost everything. And he wasn't a big businessman. So I got nervous. I said, how many small businesses in this country don't have proper advice? And my father's attorney was a divorce attorney, unfortunately. So let me tell you something very honestly, and I'm very sincere when I say this. I will help anyone, no matter how small the operation is, and I will adjust my fees accordingly. Now, some of my staff gets nervous with me, but I'm serious when I say that. I make enough money. I'm at a point.
That's the right answer and a wonderful answer.
So be aware, I will never turn someone away if they're seriously need some assistance from me. Okay.
That's awesome.
That is fantastic. That is really great.
Now, Jim, you got to understand how I even got into this stuff. Okay.
Is that it, Leon?
I totally dadded up my other question. If I remember it, I'll ping in again. Let somebody else jump in there.
All right. Sounds great. Thanks, Leon. And Norden, are you with us? Norden, you're going to have to unmute yourself. Okay. Give me a quick second here. Norden, can you unmute yourself? Okay. Brent, we're going to bring you in. Are you with us, Brent?
Okay. Hi, guys.
Hi. Where are you calling from, Brent?
I'm calling from St. Cloud, Minnesota.
Oh, welcome.
So, yeah.
What's your question you have?
Well, it has to do with the opportunity zones. And as I understood, if you've got long-term capital gains, you can defer those. There's a point at which they'll forgive up to 15% of those capital gains. And it almost sounded like that was all tax-free, but I think it's just deferred for 10 years. So you'll pay your tax on the 85%, but anything you earn in the opportunity zone going forward you're not going to pay any taxes on, or capital gains taxes.
Okay, Brent, if the investment comes from the sale of a business and from the profits from the sale, as long as at least 30% or more is invested in addition to the amount originally invested, the entire amount is forgiven, not 15%. The entire amount is forgiven. It's prorated if it's done in 5 years or 7 years.
Right.
If you hold it for 10 years, the entire amount is forgiven.
Okay. I'd love to see something.
Profit.
Yeah. Where do I find something on that?
Whoa.
Because like at year 7, they forgive like 10%, and then they forgive like another 5%. And I thought you paid on 85%, but you're saying no.
No. We work with this all the time.
Okay.
Next thing I can ask you to do is send me a quick little email.
I will.
My email address. I don't know, Jim, if you've given.
I've got it.
Yeah, and I'll just have one of my staff respond to you and give you the citation.
That'd be awesome. Thanks so much.
No problem.
Thank you, Brent. If anybody else wants to chime in and raise their virtual hand, and I can bring you in. Here's Leon again. Okay.
All right.
Leon, are you with us?
Remember my question. So I've noticed, and again, back in the game after a chunk of time away, busy running a brick and mortar, saw folks advertising where they would basically lend you money to pay off your taxes. You would pay an upfront fee, and then they would take your money and they would basically invest the money in real estate. They were building luxury condos and things like that. And you would, in essence, you would take a note for 25 years, not have to pay your capital gains taxes and they would pay it for you, and you would pay them back 25 years later. And in the meantime, you should be investing your money and covering that eventual payoff out of the interest. Are they kind of working one hand hides the other piece of that same real estate option, or is that just a total another game?
No, keep in mind that the taxes are due. So if they're paying the taxes, they're going to increase the loan of the funds they give the person, or they're going to decrease the amount of the investment by the amount of taxes they paid, plus, as you said, an upfront fee. So it's a cost of investment. And then if they can generate money, obviously with the real estate investment, because that's one of the easiest ways to work it. And remember, the 1031 exchange that Jim and I spoke about earlier applies, okay? So the individual, if he doesn't want to invest themselves, then that could be a possible investment. Look, I've got 5 sons, and one of my sons invests in real estate. And he says, Dad, I love it. I listen to you. Another of my sons says, Dad, I can't invest in real estate. I can't do it. I'm just scared. And he's extremely conservative. So for that person, I'd say, for that son of mine, I'd say, go ahead. This might be another route to go. It's like investing in a real estate investment trust, REIT. You're probably familiar with those.
Great, great. Thank you very much. Thank you, Leon. Sanjay, are you with us?
I'm here, Jim. How are you?
Doing great. Where are you calling from, Sanjay?
From just out of the Boston area.
Excellent. Well, welcome. You got a question for Bart?
Yes, I do. And Jim, thank you for putting these calls together. Your calls become my new favorite now.
Oh, thank you. Thank you. I really appreciate that, Sanjay.
And Bart, as always, great to hear you. Always full of advice. I have 2 questions, actually, if I'm allowed.
Sure.
So one is a follow-up on the first thing you mentioned about $10 million in profit if you start a C-Corp. I believe that's the QSBS section, Qualified Small Business Stock.
You can check it out. Yeah.
Yeah.
It's been around for 30 years.
Yeah, but so is there any restrictions if a buyer starts a C-Corp in 2020, acquires a business, do they have to run that business in a specific way, or just like any other business, no restrictions, and if they sell after 5 years?
There's a dollar restriction. I think it's if they get gross revenues of over $50 million a year, that's a problem, okay? But no, as long as it's a privately held operation and they run it for at least 5 years, there's no restrictions on how you have to run it, except the minimum of 5 years. Can be longer than that. And the law that's in effect when the company was created controls the way the profits on the sale are handled in the future year.
Right, got it. Okay, so that's really amazing. I think it makes sense for people to open up C-Corps. And so the second question is for C-Corps undergoing asset sale.
Mm-hmm. All right.
Opportunity zone is one way that they can avoid taxes. Are there any other strategies for sellers?
What we do a lot is personal goodwill. Are you familiar with the concept?
Not really.
Okay, there's 2 types of goodwill in a company. It's called enterprise goodwill and personal goodwill. I'll give you an example. If I've got a company selling tables and chairs, people will come in and buy because they've heard about my company and they like the fact when they come in, they see these fancy tables and chairs. And they'll pay me extra money because I've got a good reputation for the chairs and for the tables. That's called enterprise goodwill. Now, if I've got a business where people come in because they know Bart Basi, insurance companies, very personable. If the insurance agent can't sell a product, it's because of that person's personality. So if I'm selling tables and chairs, there may be enterprise goodwill, which is taxable to the company. And I'll get into that in a second with C corporations. But also, if it's personal, if they come in because of me, that's called personal goodwill. So you bypass the company's taxes. In other words, if I'm selling a company for, make it simple, $1 million, and I can prove that there's $200,000 of value because of Bart Basi, then I will have 2 contracts. One contract will be selling the assets of the company for $800,000, and one contract will be selling my personal goodwill for $200,000. Okay, I'll give you a quick other illustration and what you have to jump through. I was called in by a very large law firm in the northeastern part of the United States. I won't say Massachusetts, okay? Matter of fact, my daughter lives up in Newburyport. I'm working with some clients right now in Boston and in I can't think of the town now all of a sudden. Anyway, point I'm trying to make is the fact that this law firm called me. They were selling a funeral business. Now think about that for a second. What makes a funeral business successful? It's not the cars. It's not the funeral procession. It's not the building where they put the deceased. It's the personal reputation of the director, the owner, and if the owner knows the police department captain. So when there's accidents, they call this undertaker. It's whether the undertaker knows the people who run the hospital. So if someone passes away, they send the body over to them. So it's all I was able to help justify close to 80% of the purchase price as personal goodwill and bypass the corporation. Now, am I making sense to you?
Yep, yep. But then wouldn't that be taxed at a higher rate because
No,
it's ordinary income?
Well, wait a minute. No, see what happens is if it goes into the company, if the entire sale price goes into a C corporation, the C corporation pays 21% flat rate. Okay? There's no capital gains that apply to C corporations. So they pay a flat rate of 21%. There's no 3.8% extra on top of that for investment income. It's strictly a flat 21%. But the money then ends up in the corporation. And Jim, we talked earlier about a non-negotiable note. If the note is made out to the company, when the note is paid, the money goes into the company.
Right.
So in a C corporation, you've got to get that money out of the company. So if they dissolve the company or they take the money out of the company, then it's possible the way it's taken out can be taxed a second time. Jim, remember we talked about double taxation?
Yep.
Okay? So you would then end up paying an additional tax, let's say another 25%, depending upon the tax rate of the individual. So we can save 21% completely by bypassing the C corporation and only showing the capital gain because personal goodwill is capital gain on a Schedule D, and therefore it's only taxed at 20% or 23.8% if the 3.8% applies.
Excellent, excellent.
You're saving 21%.
Excellent, excellent. Nordine, I don't know if you pronounce your name correctly. Nordine, Riani? You're gonna have to unmute yourself. Okay, we're gonna bring in Richard. Sorry, Richard. I don't know what happened to the other. All right, Richard. Can you hear us?
Yeah, I can hear you.
Excellent. You're calling from Florida, right?
Right, right.
All right. What's your question for Bart?
You could just summarize the sale of a C corporation as an asset sale for a C corporation that was formed many, many years ago. Just a rough summary of what you said in the beginning.
Well, you got to realize the tax laws for the C corporations have changed drastically. Years ago, there were high taxes, and we used personal goodwill if we could, but it was very difficult. Today, with the tax rates the way they are and the benefits of a C corporation, an asset sale of a C corporation is very good, but you've got to be careful of what the basis is of the assets in the C corporation. If they've been fully depreciated and the basis is very low, then there's going to be a major problem. Now, having said that, I just handled the sale of one C corporation. I asked the gentleman what he wanted to do with the money, and he says, well, I'm going to invest it in real estate. So we did not dissolve the corporation, and we simply took the money in the corporation and bought more real estate in the old corporation that he was running the landscaping business with, let's say, okay? So that you can change the purpose of the C corporation, keep it there, and go into another line of business.
Well, I think what I meant was if he sells a C corporation as a C corporation, that was what I was asking.
Okay, so he's selling it, is he selling the stock?
Yeah, selling the stock of the C corporation.
All right, then that's very important. Yeah, then you got to know when he formed the C corporation.
Many years ago.
Pardon?
Like many years ago.
Okay, well, you got to go back and find out if it was before, I forgot when the law went into effect. But anyway, it's possible that there was a time period when 100% of the profit was tax-free. There was time when 50% of the profit was tax-free. Then in 2019 and 2020, it's $10 million if there's a joint return, or $5 million of a single return for a seller. So the best thing I can tell you is to go back and check the tax law when the seller formed the C corporation. Then I can tell you what's taxable on his profit on the sale of the C corporation. Okay.
But what rate is it taxed at? I mean, is it like?
Well, typically,
you said there was an exclusion of 50% of the profit, or?
Yeah, yes, back in I forgot when it was I forgot the year.
1998, I think it was. I saw another video of yours.
Was it? Okay.
Yeah.
Anyway, yes, it used to be where 50% of the profit was tax-free, and the 50% of profit that was taxable could not be taxed at a rate higher than 28%. So the maximum tax that that person would pay on the profits of the sale would be 14%.
Okay, because I think he formed it like 35 years ago. I'm not sure.
Oh, it's possible that back then we didn't have this law. And if we didn't have this law, then there's a problem. Then he can fall under the 2020 law and see if he can get the $10 million or the $5 million acceptable.
Reach
If
out
he's
to
had a
Bart.
business that long, or go back, and what I might do in that case, I might have one of my guys, one of my research guys, go back and find out when the law was passed, and since he was a C corporation at the first time the law was passed, if that law would apply. And that law, if I'm not mistaken, was close to 100% of the profit was tax-free when it was first passed. Then they lowered it to 50%, then they've raised it to a dollar amount. So if he started the company,
But in any event, it would be, he would save taxes by selling it as a C Corp rather than as an asset sale.
that's correct. Absolutely.
Yep.
Thank you.
Okay.
Thank you, Richard.
Jim, can you hear me now?
Yes, I can. Where are you calling from?
Oh, finally. Okay. I'm from Seattle, and I think Bart Basi, I have been working on his, flyers for last 25 years, which
my
I
God.
sent you.
Oh, you're the one that emailed me earlier today.
Yeah, also because I
Yes.
couldn't talk to you, so I emailed you. Anyway, but I was with VR Business Brokers in Linwood in Seattle area for about 22 years. And you were very famous in our organization. So we've been dealing with you for 25 years now.
Thank you
What
very much.
as I sent a note, I have never seen a risk-constructed balance sheet. And if you can send me an example of, what it looks like, will be great.
A reconstructed balance sheet?
Yes, example.
All right, let me explain this if I can quickly. There are three categories where you
Okay.
take a P&L statement and a balance sheet together and make changes. One category is what are called unnecessary expenses. In other words, there are expenses that occur in a business that are not really necessary to run the business. Example, they might have a relative on the payroll that is there because the wife says, you're going to hire my niece, and the niece really doesn't do much. So there's sometimes what they call unnecessary expenses. And when you add them back, that increases the profit, but it also increases the retained earnings on the balance sheet. Okay? Then there's a second category where, for tax purposes, we may expense things that really could be capitalized. Let me give you a quick, and Jim, I know we're a little over time, but if you don't mind bearing with me on this.
Absolutely.
Okay, let me give you an example. Let's assume your business has a building and all the doors to all the offices are wood. So no one can see inside what's going on in each individual's office. And you decide to change the doors and put on glass doors so they can get more light in the hallway, and also that the people, you can see what's going on if you don't want to interrupt someone working in a particular office. Now, if it's a publicly held company, that conversion from wood doors to glass doors would be capitalized and put on the balance sheet. But in a privately held company, they would simply expense it out as an operating expense. So an add back in the second category, you would add it back to the profits, but you would have to add the asset back on the balance sheet. I'm making sense to you on that one. Very important. Okay, you can't just add it back and say this is not, it should not be an expense. You got to add it back to the balance sheet as an asset. Then the third category comes with what we call owner's perks, owner's benefits. And there is a lot of owner benefits that are deductible. That this is why we don't let accountants who file tax returns and sign the tax returns for companies do the valuation, because if they acknowledge this in a valuation, they're personal for the changes on the tax return. But when you do that, you've got to go back to the balance sheet and add that in as goodwill. Now, goodwill has got to be calculated and put on the balance sheet. And when goodwill is put on the balance sheet as an asset, then under your equity section of the balance sheet, it's called appraisal capital. Okay, so you have capital stock, additional paid-in capital, retained earnings, and you have an account called appraisal capital because you've added this owner's benefits as goodwill, and you may calculate other goodwill on the business. So you've got those three categories are very, very important. It's difficult for me to send you a sample because they're all realistic that I use in businesses.
Right, right.
Sorry about that, but that's the best I can do.
Hey, Bart, do you have time for one more question, or do you need to go? I know that it's getting late.
Okay. Yeah, I'm watching the clock here too.
All right, we'll do it real quick. Manny, we're going to bring you in, Manny. You're going to have to unmute yourself. And where are you calling from, Manny?
Deerfield Beach, Florida.
All right, welcome. What's your question for Bart?
I'll make it quick because I know we got to get up. If you have a C-Corp that was established and somewhere it was converted over to an S-Corp, does that take away what you've mentioned about the C-Corp status if you convert back to C-Corp?
First of all, you got to be careful. If it was a C-Corp and converted to an S, there is a special clause that you may be able to qualify as if it was never converted. Also, you got to realize when it was converted, there was supposed to be a calculation if the value of the assets were greater at the time of conversion. There's what is called built-in gains tax. So you got to be, it's a sensitive issue when you convert over. Almost wish they never had. If they convert back, it's going to be too late. They'd have to hold the business for 5 years. So it's best to take a look at have someone take a look at the tax code to see exactly how the conversion is treated, when the conversion took place, what the tax law was at that time, and if they'll allow you to do that.
And you're only allowed to do it. You're only allowed to do an entity change every 5 years, right? S Corp to C Corp to LLC. You can only do it every 5 years, right?
No, you can always change from a S Corp and give it up if you wanted to for various reasons. If you go back within 5 years, you got to get permission from the IRS. It's not automatic.
All right,
great.
Thank you for that response. I appreciate it.
Hey, Manny, appreciate it. Thank you so much for joining, for calling in. Hey, Bart, really appreciate you calling in today or coming with us today. I really do. You were great. I would know how to tell you, Bart, real quick. I got a lot of calls and a lot of emails. A lot of people were excited for you to come on today. You've got a great name and just really appreciate the fact that you spent the time with us. I know you're very, very busy. So thank you.
Okay. That's important. We spend time, and you got to realize if your brokers are dealing with anyone in legal, accounting, whatever, just make sure that the people they deal with are current with the tax laws. It's changing every week. Before I got on this, I was reading tax laws.
Wow. Great. Well, hey, thanks, Bart.
You're welcome.
Hey, everybody, business brokers, I really appreciate you joining us today. I think it was great having Bart on, and maybe we'll have him on again in the future. He's always fantastic to listen to. Until next time, work smart, work hard, and keep making those buyer-seller connections. Thank you.